All right, it's 102. So everyone, welcome. Thank you for attending the Midyear Outlook 2022, Navigating Turbulence. Mike will be covering the economy, stocks, bonds, and policy. Prepare for a fast-paced overview of economic insights and market guidance. Throughout the webinar, please add any questions to the chat section. We've allowed time in the end for questions, and Mike will answer them on the spot. Also, if you'd like to learn more about 360 and the services we provide to our clients, stick around at the end of the webinar for a few more minutes and we will enlighten you. Now, I'll turn it over to Mike Rogers, president and founder of 360 Financial. Prior to establishing the firm in 1995, he spent 7 years building a solid financial base with two of the nation's largest investment firms. As a fiduciary, he utilizes his 30 years experience to orchestrate and implement customized strategies specifically tailored to address the issues and concerns of qualified retirement trustees, high-level professionals, and thriving business owners. Mike, I'll let you take it away.
All right, thanks, Troni. Thanks everybody for joining us today on this webinar, the Midyear Outlook. You know what we're going to cover is a lot of topics, and we're going to cover them fairly quickly, and at the same time, I'm going to try to bring in, some updated data because we put this together about a month ago. So things have changed, as you might expect. This program is really on the heels of the last program that we just did. That was very popular. We had a lot of people register for it, and it was called Bad Days Are Only Temporary. This program will have a little bit more as far as, if you will, factual data, where the last one was a little bit more, I guess you would call it inspirational data, but really from the perspective of they're going to go in the same direction. And the direction is, to the best of our ability, what lies ahead? What can we look at for clues that the best days are still to come, the bad days are limited and hopefully are behind us? Again, we never know exactly where the bottom is. But I think what you're going to find with today's program is we're going to give you a lot of really good, substantial, concrete information that will help you have discussion with your advisor about what are your next steps. So with that being said, I'm going to jump into, bulk of the presentation, which is this Midyear Outlook. And we partnered together with LPL Financial, who's the custodian of our firm. They're the largest independent brokerage firm in the country by far, and they hold our clients' assets. And so 360 is the advisor, LPL Financial is our custodian, and they do a nice job helping us put together programs like this. This one is called Navigating Turbulence. You might remember, if you joined us for the beginning of the year program, we called it Passing the Baton. And about 3 weeks ago, we had the bad days, don't last forever type of messaging within that program. So bad days are only temporary. So if you want to see bad days are only temporary, we did record that as well. We can email it over to you. And it was approximately, with Q&A, about 30 minutes long. This program will take a little bit longer, but again, I'm going to try to move along quickly so that we can cover as much territory as possible. Just give you a rough agenda. We're going to talk a little bit about what's going on in the economy. Of course, that's very important, specifically inflation. Then we'll talk about bonds and interest rates. We'll talk about stocks and the price earnings ratios and what we think is going to be occurring going forward. And the one thing that's quite a bit different from this program versus the last program is we're going to talk about the mid-year elections and how that might change policy, but really what happens when we go through that midterm election process. And by the time we do our end of the year recap or our 2023 forecast, we're going to know all the results. So we're going to make some estimated hypothetical guesses as far as what the rate of what's going to happen in those midterm elections and how that might affect rate of returns and stocks and bonds. So pretty full agenda. Now, this past year, I will tell you, and as this other thing I talked about in the Bad Days Are Only Temporary program is this past year has been tough. It's been turbulent. There's a reason there's an airplane here. Over on the left side of your screen, you see some gray, dark clouds. On the right side is some sun poking through, and we seem to be stuck kind of in the middle between these two cloudy, stormy sunny skies. And today's program hopefully will give us a little bit of insight into which direction this airplane is turning. I will let the cat out of the bag. We think it's turning towards that sun, but it's not going to be clear. Okay. So I want to, so I was just told that maybe the screen is not showing. Let me just double check something here.
Yeah, I don't think you're sharing screen.
Okay,
Sorry.
thank you. I don't know how I did that. Okay, well, good thing is we didn't miss any graphs yet. So, Charlie, can we see the screen now properly?
Yes, we can. Thank you.
Okay, thank you. Okay. So let's get through this turbulence piece and let's look first at the economy and see where some of this turbulence has been coming from. Okay, we think economic growth is going to continue here in the United States. Yes, there's a huge amount of talk about a recession. We know that. We know the news is negative. As a matter of fact, I think the stock market has almost predicted 100% chance of a recession, and not just a recession, but a deep one. And what we're looking for is growth. And so if you look at where we were last year, we had very good growth last year. And we're about 6% as far as the economy here in the US. At the beginning of this year, we were looking for about 4 and 4.5% growth rates for the economy in the US this year. Okay, we've tempered that. We're down to about 1.9 to 2.5. So that gives us basically a little bit more potential volatility in the stock market. And I'm going to highlight the piece here so that we can talk specifically about some of these points on this slide. Okay. So if we're looking at 1.9 to 2.5% rate of returns in the economy this year, what's it look like for 2023? A little bit slower yet. Now, what's interesting about this is it's still positive. A lot of people are expecting a recession, which technically it's kind of an outdated term. It's 2 quarters of negative GDP growth, which I know is an oxymoron. You can't have negative growth, but means that the economy is shrinking 2 quarters in a row. So when you look at this chart, we're a little bit more optimistic than some of the news that's out there. Now, we're going to be a little bit less optimistic when it comes to corporate earnings compared to the consensus estimates that are out there. So one thing you'll notice about this is our growth rates are actually lower than they are in the international markets and in the emerging markets as far as what's being projected. We still, if you're using what we call our 360 IQ strategy, and that's our investment parameters that we built in-house here, we still do not have money in international stocks in those strategies, nor do we have money in emerging markets in those strategies. And that has served us well over the last number of years. It does not mean we will never change that strategy. As a matter of fact, on our investment committee meetings, we talk about it every couple of weeks, and you might look at these growth rates as some indicator when we might change that strategy. If we find better growth rates are going on actually internationally, that could lead us to changing that strategy. Right now, we're still convinced that the US going forward has the best opportunity, not only for some growth, but also for a stock market rebound. The other thing you'll notice on this chart is inflation. Inflation has dropped on this chart we anticipate it's going to drop from 6.6 or 7% by the end of this year. Remember, we're at 9. So if we went to 7%, that would be a pretty substantial drop in inflation to maybe about 4%. I'm going on the high range of both of these estimates from LPL Financial. So 7 at the end of this year and 4 at the end of 2023. Wild card is inflation. And we're seeing inflation globally as well. And the central banks globally are pushing up their interest rates. We have less negative interest rates throughout the world like we did a year ago. And inflation is something that's going to have to be harnessed as much as possible on a global basis. So we do think there's enough momentum going forward to offset some of the inflationary pressures that we're seeing. And I'll talk a little bit about that a little bit later in the program. Okay. But I will give you some clues. We see bottlenecks improving, and as that happens, we avoid a recession, and we continue to grow a bit slower than what we have in the past, no doubt about it, from 2021, will continue to grow. Okay. This next chart here shows consumer spending and consumer debt. And this is a very important chart when it comes down to looking at how the economy is doing. I'm going to talk about consumer sentiment and consumer confidence a little bit later. But right now, when we look at the consumer debt ratio and we look at how much they need to spend to cover their debt. In other words, what's the ratio between the two of them? You see they're tracking both downward. So the financial obligation ratio is really pretty simple. It basically just says, if, and this is the orange line, it just says, basically measures how much the household income is being spent on repaying debts. And it's dropped substantially because the consumer really leveraged themselves after the 2008 financial crisis. And that's why we have this downward slide. We do see some volatility in that when we get into, the more recent COVID years, but we're still below where we were before. Okay. Also, the debt service ratio is just really a measurement of how much debt the consumer has. And you can see, again, pretty substantial drops coming out of that 2008 financial crisis, and then leveling it off for about 5 or 6 years, and then dropped quite a bit with COVID. And it the blue bars, basically what we're showing there in those blue bars is revolving credit has dropped, debt load has dropped. And so even if the consumer, and this is a key point here, even if the consumer is getting pinched by higher costs, and they are because of inflation, they have such low levels of debt that we do think the consumer could use more debt in the second half of the year, where we're in right now, to continue to spend as they need to. And so this is a really good picture when we look at low debt with a cushion between their debt and what their spending is to take on a little bit if they so were inclined. And we think they probably will. Okay. So I think basically that gets the point across on that piece. So how about an economic forecast kind of going forward? And the one thing that we look at when we're going forward is the supply chain bottleneck. We've got to get some sort of resolution on that in order to drive down inflation. Okay. And we're getting some really good data that says this is starting to improve. And what this chart is showing you is order backlogs. And what's important about order backlogs is it kind of gives us an indicator of what's going on overall as far as supply and demand imbalances. And you'll see over on the right-hand side of that chart that the order backlogs are starting to decrease. Okay. And this comes out of the Institute of Supply Management, and they've got a number of type of criteria that they're looking for. It's really focused around manufacturing and service sectors, and where is that going? So order backlogs decreasing should help us, and as the transportation sector kind of recalibrates to a current or normal type of environment, the economy could likely see some growth in the later half of the year and again avert a recession. Okay, so firms, bottom line, are restocking their inventories, and these backlogs are starting to decrease. So if you're restocking inventories, let's just look at car lots as an example. You bring more cars onto the lot, you're restocking that inventory. That's good for the manufacturer to restock that inventory, but the bottleneck has been the problem in the past, and we look for that to improve. So let's look at some other forecasts for the economy and look at specifically CPI. Okay, so we think inflation rates will cool this year. Okay, and there's a couple of reasons, as I just talked about. One of them was that supply chain, but look at this chart. And again, there's the improvements in the supply chain impact consumer prices. Well, you'll also notice that this chart is put together by the New York Federal Reserve, and it's talking about a pressure index. Okay, and I went back and I looked at June data, the most recent data. Now they actually revised this chart just here in July, but it's June data. And in June, what we're seeing is a decline in this supply pressure index by a pretty substantial amount. And that falls on the heels of a decline in May. So what we end up having is, if we can get, again, a decline in supply pressure, that should be good for the overall economy and should lead us potentially into a better looking stock market. Okay. What else can I tell you? I'm looking at a couple of notes just so I get this correct. Chain have been decreasing at, but the other point is it is at historically high rates. So we still have a ways to go to get back to the pre-pandemic levels of supply chain pressure, but we're moving in the right direction. The other thing I'll point out to you, if you look at the orange line is CPI. And you can tell that the blue line is a little bit of a leading indicator to inflation, especially when you look at the extreme in 2020, when the pressure index leaped up. And then it took a little while, but inflation also leaped up. And so we would subsequently hope that we see a correlation between these lines again, and we'll start seeing some inflation dropping. Okay, we're at 9% inflation rate. So we got to remember that inflation rates are gauged on year-over-year data. So the one thing is rates should start dropping as we're comparing to higher rates from a year ago. Okay, so that will be a positive. And we don't think we're in a marketplace like we were back in 1978 and 79 when interest rates were 14 and 15% on your mortgage, and you could get 14 or 15% on your money market at the bank. Paul Volcker aggressively increased interest rates because we had years and years of inflation. This is a little bit different environment, but 9% is still a high rate. So we expect that that's going to drop. And we've already seen some clues around that. Take this slide out of the equation and just look at where else have we seen some clues. Commodity prices. Commodities have been dropping. Timber prices have tumbled in price since they hit their high in the spring. They've been very volatile, but timber prices, anybody building a home, that's good news. Oil now is trading at $97 a barrel, and it topped out at $123 a barrel roughly. So that's good news. Copper prices are at very low levels. A lot of the ag prices have come off of their highs. And when we look at oil, we can even just look at the gas pump. We were routinely seeing gas prices at $5 a share, $5 a gallon. Now they're about $4.45 a gallon. Still historically high. Especially if you compare it to last year, but trending hopefully downward so that we get a little bit of some relief from these inflation data numbers. So how does this impact stocks and what's going on in the stock market? So there's no doubt stocks going to face a lot of headwinds. We've got an environment that's very volatile, that's filled with some uncertainty. That is a tough market, to be bullish in. But we do think, whether it's the program that we just did recently or this program, we're going to give you some insight into why we should at least be optimistic around the stock market and the stock market returns. I know a lot of you have heard this S&P 500 has had its worst start of the year in 52 years, since 1970. The S&P 500 in 1970 was down about 20%. The stock market here this year was down about 20%. If you only look at the S&P 500, if you look at the NASDAQ, it was down about 30. If you look at small companies, it's down even more. So just focusing on those 500 large US stocks, they were down 20%. Let's go back to 1970, the worst time that it's been down as much as we've seen this year. Okay. I think a lot of people would be shocked, or at least surprised, when I asked the question, well, how far do you think the stock market ended in 1970? Okay. And to their surprise, then usually it actually was up. It was up 4%. So I'm not predicting, I'm not saying we're going to have every single month go up. We've got a good July going here right now, and there's no guarantees that what happened in 1970 is going to happen in 2022, of course. But it does give us some optimism that when the doom and gloom is this is as bad as 1952, excuse me, 1970, 52 years later, that there's some hope that, hey, maybe we'll have a market that looks like 1970. Okay. So let's look at a little bit of the data that might reinforce that. Okay. First of all, stocks tend to perform better when inflation is low. Okay. And that for a number of reasons, but what this is showing on a chart here is inflation data. And the inflation data is, I'm really trying to get my pointer working for you guys. Let me just check this out. Okay, that might work. So inflation, when it's very low is when the stock market price to earnings ratio are at their highest. And so that's what we are coming off of course, very low inflation. Some of you on this call have been collecting Social Security benefits for a number of years. And there was years where there were no increase in those benefits because the government looks at inflation data to decide to increase those benefits. And so now we have inflation. You should expect to see an increase in your Social Security payments in 2023, just like you did in 2022. But as inflation goes higher and higher, the stock market trades at lower multiples. And so what we need to have, the wild card, at least to help us here, is inflation improving and maintaining more of a kind of a more normal, if you will, multiple. Now, we're still a ways away from the targeted Fed Reserve rate of 2%, no doubt about that. But if we think, and this is the consensus from LPL on their research department, that we'll see inflation drop about 1.5 percentage points this year. And that's off of what we call core consumer inflation. And this core personal consumption inflation, or PCE as it's called, is what the government kind of looks at when they're determining, their targets. And this core personal consumption expenditure index, that's a mouthful, excludes food and energy. Okay, two of the biggest drivers of inflation this year. Okay, and so it does include used cars and new car prices. That's the third largest component of inflation this year. So what we're looking for is, and oh, by the way, that index in April came in at about 5%, and in May as well. So up a little bit, of course, from where it was a year ago, up quite a bit from where it was a year ago. But when we start looking at this core number and we start looking at inflation of 4 to 6%, it's telling us that multiples on the stock market, can easily be, 15% and can start climbing to 18 or 19% looking at forecast going forward. If inflation, and here's our wild card, if we're wrong and inflation consistently stays at high, numbers like 9% or 10%, that is more difficult for the stock market to trade at higher valuations. And the reason is pretty simple, is a lot of times the margins are being decreased because of inflation at companies, therefore their earnings decrease. And the other thing is when we have high inflation, you have alternatives. You have bonds that you can invest your money into that will be paying higher interest rates. And we've already started seeing that this year. I'll talk about that in a minute. Okay. So we're expecting inflation to decrease. That should be good for the stock market. Okay. We're also expecting that, I've got to get rid of the highlighter here. Sorry about that. We're also expecting that when we get into a scenario where we look at earnings, how is this going to look like? And so we have to look at earnings on a holistic basis. And so what this chart is showing you is real simple. It's what earnings have been in 2019, 2020, 2021, and then kind of what's forecasted for this year and for next year. The blue area represents what we're getting from our LPL research partners, and we agree with that. The little bit of orange on the top is is the bar that shows earnings estimates are higher, if you will, from other firms. So we're actually being a little bit, I can't say pessimistic, but we're being a little bit more cautious on the earnings front. So far this year, earnings have been kind of volatile. The first quarter wasn't bad, wasn't the greatest picture ever, but at the end of the day, when the first quarter was done, S&P earnings were up about 10%. So again, let me repeat that. S&P earnings were up 10%, and that's a pretty good number from the perspective of growth. Okay, and going forward, what we're hoping for is earnings per share, could grow in a similar manner. Maybe it's about 8% throughout the rest of the year, so that we can get to about $225 in earnings on the S&P 500. Okay, that's kind of the goal here. Now, the quote unquote, the street, the market is looking for another $5 on there for about $230 in earnings. Look at where they were back in 2020, about $140. So in huge jump up in 2021, we still think we're going to see earnings increase for the rest of this year, and we'll see them into next year. Not as substantial of a jump, of course, as we saw, but the trend is moving to the right and upward, which is positive for stocks. Okay. So I talked about the consensus is still about $5 below average. How about in 2023? I wanted to talk about that. This orange area that's on the bar on top of the blue area, that's about a $16 difference. And so the street's looking for $251 in earnings by the S&P 500, and we're looking at about $235 in earnings. So if the street's right, that should bode well for stocks, and maybe we're being a little bit more cautious than other firms, but I think that's okay. In this sort of market, being cautious is fine. Being scared to make any moves and to change your discipline and your strategy is not beneficial to you at all as an investor. So when we look at this $225 number or $235 number, what does that kind of lead us to? Well, if stocks trade at, let's say, an 18 multiple of earnings, that's what gets us to about an S&P 500 of 4,300 to 4,400 for the end of this year. Okay, you might say, okay, well, Mike, what does that mean? Well, this is a P range of 18 to 19, which is lower than it was going into this year. We were about 21 going into the year. So we're discounting the multiples a little bit. And we're saying, if we look at where we're at right now, and I updated the numbers, the S&P 500 is about 3,900. It's actually 3,950 today. We're having a good day today. And that's because some earnings came in last night from some of the large tech stocks that have driven up some of the stock market valuations here in a day. Is all. Day does not make a trend, of course. But if you look at kind of where we're at, at 3,900, you're basically looking at about an 11 or 12% increase from here. And when we did our, bad days are only around for so long type of message last couple of weeks ago, what we talked about was stock market, growth, and we're actually about 8% up from where we were at that last program. So, it looks like, bad days are only temporary, and it looks like, stocks are starting to improve. And if we can get up to a valuation of 43 to 4,400, doesn't really mitigate the entire year, but it gets us at least to a point closer to break even. Okay. So what else is there? So that's pretty attractive, from the perspective. I think it's realistic from this perspective as well. So what could cause this to kind of get turned upside down? Well, one thing that could happen for sure is that these earnings just don't come in. And these earnings are going to be all over the board. GE announced yesterday good earnings, and it came out of their jet division. Microsoft and Google/Alphabet announced good earnings, and that's a positive for the tech stocks today. On the flip side, Walmart yesterday announced that their earnings slumped, and the stock dropped about 7% in one single day. So we're going to see some volatility. What we need to see is the whole group at least moving up a little bit, and we think that's going to occur. Um, keep in mind some other factors I talked about, and the bad days are only temporary. One is the consumer confidence index. I don't have a slide on that today, but the consumer confidence index is something that the University of Michigan has been tracking since 1971. And there's been basically 8 times where that index has tanked, been very, very low. We're in the 9th one right now. As a matter of fact, the index is now as low as it ever has been by a slight amount. And what that tells us is that the consumer is very pessimistic about the economy going forward, which, by the way, doesn't bode well for the midterm election, which I'll talk about in a second. But what's interesting is when the consumer feels the worst is usually when the stock market starts to do really well. For example, the 8 other times when the consumer index has been about as low as it is today, 1 year later, the S&P 500 has been up 24.9% on average. Again, repeat that. When consumer index is in the tank, like it is right now, the S&P 500 is up almost 25% historically. Again, will it happen this year? We're going to find out. But I do know one thing. When the consumer confidence index is at its highest level, when everybody's feeling, this time is different and it's going to always be good, the stock market 1 year later generates about a 4% return. Okay, so we weren't at those high levels coming into 2021, but 2022, but we definitely have dropped down here in 2022 and have gone into very low levels. So it's a contrarian type of index, really, from our perspective. It's the old Warren Buffett adage. You want to buy when everybody's greedy. You want to sell when everybody's greedy and buy when everybody's fearful. And that's exactly what that index is kind of showing us. Okay. We also have some changes coming out of DC. We have elections. We have a midterm election. And we'll talk a little bit about that when we get to some policies. So let me just spend just a little bit of time on bonds. Because the bond part of the portfolios is real important for a lot of our clients because we're in what we might call moderate strategies, which does have some bond exposure. Okay, and bonds have not done well this year as interest rates have spiked up. For example, the 10-year government bonds gone from about 1.4% to over 3%. Sitting currently at about 2.7%. That's bad for our bonds and bad for our bond funds as far as the prices. And this has not been, just one area of bonds. So if we look at the Barclays bond index, it's negative for the year. If we look at the muni bond index, it's negative for the year. So is there some hope out of the bond part of the portfolio? Well, there is. Bonds typically are in the portfolio to act as a diversifier, then to provide liquidity, of course, and to hopefully give us a little bit of some positive returns to use that interest for either income purposes or to use it for buying other bonds, an additional reinvestment strategy. We haven't had a lot of any of that this year. So as rates have gone up, bond prices have dropped, but what you're going to find in this chart is a great representation of it. We actually think there's some opportunities in here. Up till this year, we had what was called the TINA effect, TINA. I know most of you have never heard of it, but there is no alternative. Okay, so the no alternative was when interest rates were 1% and CDs were less than 1. You were maybe forced to consider putting more money into the stock market. And that drove up those valuations to multiples of 21 and 22. But now there is an alternative. Yields have gone up, whether it's across the board. And as yields have gone up, and that attractiveness of stocks over bonds starts to minimize for the more conservative investor and the more moderate part of the portfolio, we have an opportunity going forward, we think, to make some nice returns in this area just from the yields. We need to see interest rates drop back down in order to get a total return, price appreciation plus yields. And we don't think that's any time in the very near future. But from a yield perspective, this chart gives us some optimism that the 60-40, 60% equity, 40% bond portfolio has some real merit going forward. And so what we're showing here is just bar charts on the range of yields for different types of bonds. And then the blue dot represents what the current yield is. And then the orange line represents the median yield. And so what you see across the board, in almost every case, except for high yield muni bonds, is a current yield, which is higher than the median yields. And so the Bloomberg High Yield Index, 7.79%. So we can get almost 8% in junk bonds. Now there's risk in junk bonds versus corporate bonds, so we have to take that into consideration. So let's move towards the right where there's less risk. How about the Bloomberg Municipal Bond Index, which is the second bar from the end on that right-hand side? That's a 3% yield. That was trading at about a 1% yield a little over a year ago. And the median on there is about 2.25% yield. So for the yield sensitive investor and for the moderate portfolio that has money invested into the bond part of the strategy, this is really good data and gives us some hope that fixed income is an opportunity for us because we haven't seen yields at these levels in a decade. Okay. Now, I will be very frank, if we've been holding bond funds and your tax-free municipal bond fund is down 10% for the year, that's unsettling. But we do have times where bonds and stocks don't move in opposite directions. And that's what we've had this year. And so what this is showing you is a correlation breakdown between the bond index and the S&P 500 index. And across that zero line where there's zero correlation, stocks and bonds are moving together. They're moving either up or down together. It doesn't matter, but they're moving together. And that's exactly what we've seen this year. And that does happen from time to time. And typically what happens is stocks and bonds move in separate directions. That's the bottom half of this chart. And so it's not completely uncommon to have what we've been experiencing this year. Because it does occur. We just think we're going to shift back to what's normal and we'll get more of a, separate or almost a non-correlated effect between the two. And frankly, there's just a lot more cushion for bonds to act as a diversifier when the yields are at 3, 4, 5% versus when they're at 1%. So I think that's real positive news. And I think that's positive news for our clients that are utilizing, let's say, the growth with income IQ strategy, which is typically a maximum of about 60% stocks and 40% fixed income and some bonds. Right now, we're holding a little bit more cash than we normally do, but it's basically a 40% allocation towards bonds. And going forward, getting some better results out of that is what we're hoping for. Now, if inflation, going back to my wild card, stays at 9%, and the Fed today is going to announce an increase in interest rates, and everybody in the free world knows it's going to be 0.75%, or at least thinks it's going to be. So everybody's anticipating that. But if inflation keeps being persistent and we need higher and higher interest rates, then this might be a little premature as far as the opportunities within bonds. So you do have to believe that inflation is going to start to curtail, and therefore interest rates won't keep going up and up and up. Okay. So with that, let's talk a little bit about policy, because I think this is one part of the program that will be very interesting, especially in a couple of months. Okay. I'll go back to this slide for a second. Midterm elections are a little bit of a balancing act for voters. So right now this is no different than any other time, but let's historically look at what's going on with midterm elections since 1900. Okay, so kind of long data. The president's party, the sitting president's party, has lost House seats in midterm elections 87% of the time. Okay, averaging 30 seats lost. Okay, in the Senate, where there's not as many seats coming up for midterm elections. There's only about a third of the seats are up for grabs here in November. The president's party has lost seats 67% of the time, with an average loss of 3 seats. And so we are going to make a little bit of a prediction here on policy, and obviously things can change drastically between now and November. But it seems likely that the current president is going to lose seats within his party, both on the House side and probably on the Senate side as well. Okay. And there's been some extreme examples. The only time recently that this has not happened, where the sitting president has lost seats on his party, was when George W. Bush was in office right after 9/11. And that wave of support that he had during that time period, they actually gained seats on the Republican Party side. So I think the Democrats are going to have a hard time controlling, the slim majorities that they have right now, especially if you just look at history. But if you also look at right now, we also have very low approval ratings by Biden's administration, or for Biden's administration. And, the consumer is feeling very, very, I don't know, depressed about the consumer as measured by that consumer index that I was talking about as far as the economy. So that bodes a tough road for the Democratic Party to maintain a lot of this slim majority that they have. And and then you have inflation, which is impacting a lot of people, especially as gas prices have jumped up, even though they're trending downward. So it's going to be tough. And we do think that, we might see, from the perspective of the Republicans taking control of the House, and the Republicans maybe getting some, slim majority in the Senate as well. Okay. Now, we are not, I want to be very, very clear, we're not trying to mix politics with the investment front, and we're not getting political here, especially nowadays. That's a very, very polarizing conversation. What I'm looking at is historical trends, and I'm looking at kind of what's happened in the past with those historical trends, and say what potentially will happen going forward. So here's why I don't want to get political about this. What this is showing is midterm elections have affected kind of stock market results in the past. And so this chart goes back all the way to 1950. Okay. And the year after the midterm elections has been very strong for stocks, whether it's a Democratic president or a Republican president. Okay. That's sitting there. So incredibly, the S&P 500 has been higher a year after every midterm election since 1950. That's 18 out of 18 times that we've been higher after a midterm election. And the average rate of return, the green line over here, is 14.5%. And you know what? Breaking it down by party lines, whether you're on the left or the right of the aisle, doesn't really seem to make much difference. The Republican president experiences a stock market gain of about 14.5%, 14.8%, and a Democratic president about 14.5%. Okay, so it's interesting to see it doesn't tend to make that much difference. As a matter of fact, what the markets like best is a scenario where Congress is a little bit in gridlock. So let's look over on the left side where we have a Democratic president. So we have Joe Biden sitting as our president. That's not going to change here in November, most likely. I guess it always could, but most likely is not going to. And so when the S&P 500 returns are impacted is interesting. So when we have a Democratic president, and then we have Republican control of Congress, which is the blue chart in the middle, the S&P 500 is up an average of 16%. Okay. So if that does happen, maybe that bodes well for a good stock market. But let's just say we have a scenario where the Democrats hold on to the Senate, but they lose the House, probably the second most likely scenario. That split still brings stock market returns that are very, very positive, 13.6%. Okay. And if the Democrats can control both, both the House and the Senate, you're looking at a 10% increase. Okay. And so we think most likely that blue one in the middle with Republican control and possibly the split between the two parties will occur after this November election. So I guess what I'm trying to get at here is while the November elections bring change, and change is sometimes good, sometimes not good, it does tend to bring optimism that things are going to improve no matter who is sitting as president. And the Republican president numbers we don't have to worry about here right now, but you'll see they're actually a little bit less except when you get into a split. So again, the markets tend to like a little bit of stalemate and tends to like a little bit of check and balances within the system. And that's when you get your best rate of returns in a Republican president. Okay. So I have covered a lot of ground, and we want to leave some time for Q&A. It's been 45 minutes since we started up the program. And of course, we always have some disclosures about how stocks are not guaranteed to ever go up. And we have some definitions about risk and definitions about credit quality and everything else that, the government makes us put onto these presentations. But with that in mind, I'm at least going to stop sharing my screen and turn it back over to Troni to see what sort of questions might have popped up.
Certainly, we do have a couple questions, and I would encourage anybody to ask the questions in the chat, and Mike will field them as we go along here. So the first question I have for you here, Mike, is how does the housing market affect this outlook?
Okay, well, the housing market obviously has been on fire, and prices have illustrated that fire status. I mean, 10, 15, 20, 30% price increases are just not sustainable in the housing market. That's going up faster than wages are, despite the fact that here in Minnesota, we hit 1.8% for unemployment. Again, you think the consumer's in pretty good shape? Every consumer's got a job, but unemployment's at 1.8%. And that's really driving up some of the housing activity until recently. So the Federal Reserve policy of increasing interest rates has also bled right into the mortgage rates. And mortgage rates are up over 5.5% now. They were 2.5%, maybe 3% a year ago. 5.5% is not completely out of the norms. Matter of fact, we just got used to 3%, which is historically unnormal with mortgage rates. So we think the housing market will finally slow down. That will actually be good. That will help with inflation, because remember, when you go into a house, brand new place, or you buy a new one, you start redoing it. You buy new appliances, you buy new wood, that drives up timber prices. You buy paint, you buy sheetrock. That's really what happened also in COVID. People were sitting around their house and they started buying goods because they couldn't go on vacations, and it created this bottleneck in the supply chain. So we think a lot of that will start to slow down, which will slow down the economy, but again, not send it into a recession. So hopefully that answered that question.
Yes, great. Thank you. Can you talk about what and how stagflation works and how it impacts the outlook?
Okay. Stagflation is a term that we haven't heard for a while. It's kind of come back in vogue. It's on the news sometimes. So what is actual stagflation? That's when you have high inflation rates and low growth rates. And the third leg to that stool is high unemployment. Okay, so right now, as I mentioned, in Minnesota, we have the lowest unemployment rates ever. And not for Minnesota, but for any state in the country, 1.8%. Federally, for the entire country, we're sitting at about 3.6 or 4%, I think might have been the most recent number. Okay, so we're nowhere near the true definition of stagflation, of high unemployment, high inflation, and slow growth. Okay, we think inflation will start to peak and start trending downward. We think growth will continue. Stagflation even would be a recessionary type of economy, which again, we don't think is going to be the case. But it is a term that a lot of people have been talking about recently, and they really just look at it from two aspects. They look at it from that growth rate and that inflation rate, and they forget about the unemployment rate. As a matter of fact, one thing we want to keep an eye on, everybody here watching and us here at 360 Financial, is we want to keep an eye on that unemployment number, because we've never gone into a recession where unemployment is down, trending downward. We've always gone in when it's trending upward, and all we've done is trend downward since the numbers that were during COVID. Here in the U.S., for example, we got to 14.8% inflation during COVID. 14.8% unemployment during COVID, and now we're sitting at this 3.4% number. So drastically different picture. And we're actually at 3.6. I just misspoke. It is 3.6 because the lowest that we ever hit nationwide was 3.5. So don't worry about stagflation as much as inflation and tracking that. And if we see unemployment start reversing itself and moving upward, that would create a little bit of concern on our part.
All right. Well, that is it for our questions today. Thank you all for your time, and we'll be emailing out the webinar after the recording is approved, and we will send that out as quickly as we can. This will conclude the program, but please do join us if you'd like to learn more about our high-level view of our IQ investment strategies and how we work at 360. Unless there's anything else you would like to add in here, Mike.
The only thing I'll add in, I think is real important, is we talked about a mid-year outlook. We talked a lot of data points here. What I want to make sure that everybody on the call is doing is we have a number of really talented financial advisors here in the office. I work with a lot of you, others on the call work with other advisors within the office. Really talk to the advisor and say, has this changed where our goals are set? And do we need to reset goals? As far as this current market is. I think what you'll find is if you have that conversation, that's the most important aspect of what you can do is look at your goal setting, look at the path, look how you can be proactive and not worry too much. I know it's hard sometimes about all the negativity that's swirling around. So hopefully this program gives you a little optimism that things are going to improve, and we think they are going to, obviously. But also just make sure you talk to your advisor and really have a meeting about what's the future look like for you and your family. That's really what's most important. And we'll talk a little bit about that for the people who want to stick around and learn a little bit more about our process too.
All right. Well, thank you all again for attending. We will move on into the 360 explanations as there are no more questions in the chat box. So we will move on. Thank you.
All right. You are very welcome. I will screen share. I'll go back to where I was a little bit as far as getting the screen share correctly. But, when we talk a little bit about our strategies and how we work with our clients, you're really focusing on building what we call our life wealth plan around these really important matters. And what matters, what's important to our clients is their family, their occupations, and their recreation. I mean, these are the whys of what we're doing when we're working with clients to build planning strategies. Okay. Now the money is the how. Okay, money drives the flexibility to take care of your family and occupation recreation goals. Money's the gas in the engine, whether that gas is $4.44 a gallon or $3 a gallon. Money is that gas. It drives, it propels our goal setting strategy around family, occupation, and recreation. And we call this form. And this is one of our three uniques that we use here at 360 Financial is we build our strategies around form. And most financial firms, and there's a whole bunch of them down the street here, only focus on the money aspect without really a good idea of what's really important to the client. And we also know when we talk about what's important to the client, we really have to focus on the things that we can control and the things that we can't control. And we know, let's take that out of there, we can control our philosophy, we can control our planning process and how we follow a discipline. At the end of the day, we just had a great program on the Midyear Outlook. We can't control whether the stock market is going to be up the rest of this year or not. We know over long time periods, the rate of returns from stocks are X, and we can use rate of returns from bonds at Y, and we can build portfolios that will address those longer term rate of returns. But we can't control what happens today or this month or this year. What we can do at best is make predictions on those things. But what we can control is how well diversified is a portfolio to meet your investment objectives and therefore meet your family occupation and recreation objectives. How disciplined are we to stick with a strategy instead of bailing out on it after it's already gone down, which so many people do, unfortunately, to do maybe the opposite, to do what Warren Buffett would do, and that's buy when everybody is fearful. How do we come with the low cost strategy to keep your fees down so that you're more likely to hit your goals? Those are the things that we can control. And those are the things that we want to focus on. And when we can take those aspects of what we can control, discipline, investing, diversification, and those things that matter to you, your family, your occupation, your recreation, we put those together. That's the sweet spot. That's where the life wealth plan lives. And this life wealth plan is a working document that you get actually a paper copy of in our life wealth organizer that has everything about your financial life in that binder. If you want it electronically, we can do that, of course, too. But the purpose of this organizer is to create an opportunity for you to have something that looks at all the critical financial events in your life, whether that's retirement planning, tax strategies, investment strategies, looking at your family and what needs that they have, whether it's something as robust as paying for college tuition, or something as sad as a loss of a spouse or somebody within the family. Okay. And that transfers into what's the legacy look like. We've got a great program that we're going to do here in about a month that talks about legacy planning and what a positive legacy means versus a negative legacy. And I think you'll really enjoy that. And if you're a business owner, and lots of our clients are, what strategies should you be utilizing, not only while you own the business, but if you look at selling the business as well. Okay. So this all-encompassing 360 view, hence the name 360, goes through this process for new clients. The very first thing we do is we have a couple of meetings. We talk a little bit about how we work with our clients and what you might need. And we see if there's a fit. Do we have something that aligns from a commonality perspective? That's usually a 2-meeting cadence. And if we agree that's a good fit, we can bring value to you, and you need our help to delegate some of this responsibility, and then we can move on to the get organized phase. And then that part of the process is, let's pull together all your financial data. Let's build a net worth statement, personal statement. Let's look at all your debt, all your assets, and start organizing it so that we can get it in a manner where we can look at setting in motion an implementation phase and start looking at, through this planning process, what are the most important things that we need to cover today, and then what are the following activities that we need to do over the next year, and how do we update those on a regular basis as we review your goals and we review our strategies and realign them, because everybody's goals change at least a little bit, and so we need to align the process around your flexibility of your goals, because the worst thing that could happen is you've got this great, beautiful financial plan, a life wealth plan, and you never go back to it. You never revisit, are we on track or are we off track? You never go back to say, we thought it was really important to have a house in Brainerd. We decided we'd rather have a house in Fort Myers. What does that mean to the strategy? Or we want both. Okay, so this process gets you to the point where you can look at an investment strategy that we use called the foundation and leaders approach. And it's a diversified strategy that uses, very low cost institutional funds and exchange traded funds to drive not only a foundation of diversification, but hopefully also allows us to take advantage of kind of the leadership in stocks and where is money being made now with part of the portfolio, and this will be very dynamic, especially on the right side of that screen. And the foundation piece is just a matter of rebalancing and keeping costs low and providing a lot of dividend paying, good quality companies and good fixed income alternatives inside the portfolio. The right side, when we meet every 2 weeks at the investment committee meeting, we always go through our rankings of 36 different areas of the markets that we think give us opportunity to invest. And these rankings are based on a number of criteria, and they will change. Right now, we, for the most part, have money in healthcare, some energy stocks, semiconductor stocks, are three of the big areas that we have funds invested into. And we think going forward, as we make changes to the portfolio and technology maybe starts improving, we'll come back to some of those stocks. But right now we tend to be a little bit more defensive in that mix. Oh, and we also have a basket of stocks that are investing into infrastructure and everything that's going on in this country with the $3 trillion, I think it was $3 trillion package that was passed last year to build out better roads, bridges, and infrastructure. So it gives you a little bit of an idea of how we work with our clients overall, and not meant to be, if you will, a sales pitch, but for the people who aren't working with us right now, feel free to schedule a time with us. We can go through your specific situation and kind of start that fit process. So with that, Troni, I see you're back on. Has any other questions popped up about that? I know it's only about 5 minutes. So we normally don't get questions, but thought I would ask.
There are no questions.
Okay. So, all right. So with that, we are going to end today's program. Thank you for spending an hour out of your day with us. And it's a beautiful Minnesota day. And hopefully you can get out there and enjoy the rest of it. And if there's anything that we can do, or if you have any questions that weren't answered today, just shoot us an email, give me a phone call, and we'll help you out as best we can. So thank you, everybody.
Thank you, Mike.